Hey everyone, welcome back to Corporate Decoder, the place where we dissect financial reports for juicy insights and sometimes for downright scary warnings. Get ready, because today we are diving into Everest Group Ltd's annual report. And folks, it is a thick one packed with numbers about insurance and reinsurance world, where predicting the future is part of the job description, but also a huge risk. Everest Group Ltd has just dropped its annual report for the fiscal year ended the 31st of December 2025. And there is a lot to unpack here. This isn't just about numbers on a page, it is about how this global reinsurance and insurance giant navigates a world full of unpredictable events, from natural disasters to financial market swings, and how they plan to keep their promises to customers and shareholders along the way. Let's cut straight to the chase. Everyone cares about the money, right? The financials in this report paint a picture of a company that has grown but also faced some headwinds. For 2025, Everest Group Ltd reported a net income of $1.6 billion. This is actually up 15.9% from $1.4 billion in 2024, which is good news. But hang on a minute, when we look at the previous year, 2023, their net income was a whopping $2.5 billion. So while 2025 is better than 2024, it is still a significant drop from 2023. And here is an interesting tidbit: income tax expense more than doubled from $120 million in 2024 to $296 million in 2025. This is partly because of the new corporate income tax in Bermuda starting in 2025, which is a 15% tax. This new tax is affecting their bottom line, and it seems like they have some complicated ways to deal with it, with deferred tax benefits and global minimum taxes, things you definitely don't want to mess up. Now let's talk about premiums. The lifeblood of any insurance company, gross written premiums, actually decreased by 2.9% in 2025 to $17.7 billion compared to $18.2 billion in 2024. This drive up is due to a few things, mainly in their insurance business, which saw a nearly 6% decrease. This suggests they're either strategically pulling back from some areas or facing tougher market conditions. There was also a big drop in their other segment, which they now have because they sold off some businesses like their sports and leisure operations. This next number is crucial: the loss ratio. It tells us how much they paid out in claims compared to the premiums they earned in 2025. Their loss ratio was 69.8%. That is an improvement from 74.4% in 2024, but still quite high compared to 2023's much better 62.7% loss ratio. It shows they're still dealing with higher claims costs than they were just a couple of years ago. And the combined ratio, that is the grand total of losses, commissions, and other expenses compared to premiums, earned well in 2025, it was 98.6%. That is good news because it is under 100%, meaning they made an underwriting profit. But remember, last year in 2024, it was a worrying 102.3%, meaning they lost money on their core insurance business, so they're heading in the right direction. But there is still room for improvement. Something big happened in October 2025. They entered into these adverse development reinsurance agreements. This means they've offloaded some of the risk for potential future losses from past events. Especially in their North American liabilities, they paid out a significant amount of money for this protection, which shows they're serious about managing those unpredictable claim costs. And speaking of managing risk, they also sold off the renewal rights for some of their commercial retail insurance business to AIG in October 2025. They said this sharpens their focus on their core global reinsurance and specialty insurance businesses, which makes sense if they want to concentrate on what they do best. This sale brought in about $252 million. Looking at claims and expenses, incurred losses and loss adjustment expenses decreased to $10.9 billion in 2025 from $11.3 billion in 2024. This sounds positive, but the report points to unfavorable development on prior year attritional losses. Contributing to this number, they had to increase reserves by $657 million pre-tax. Specifically for us casualty lines, which have been hit hard by social inflation factors, like more frequent high-severity claims and third-party litigation funding, this is a recurring theme and a major risk they highlight. On the balance sheet side, total investments and cash grew to $45.4 billion in 2025, up from $41.5 billion in 2024. This shows they're accumulating assets, which is generally a good sign for financial health. And shareholders' equity increased to $15.5 billion from $13.9 billion. This is mainly thanks to the net income they earned and some good news from their investments, which had unrealized appreciation. But these gains were partly offset by share buybacks and dividends, which reduced equity. Now let's talk investments. Net investment income increased by 8.7% to $2.1 billion in 2025. This is a solid gain driven by higher returns from fixed maturities and limited partnerships. These partnerships are a bit of a wild card though, as their value can fluctuate quite a bit. When it comes to strategy, Everest is focused on disciplined underwriting, meaning they prioritize making a profit on their insurance and reinsurance deals over just writing more and more business. They are carefully selecting risks and adjusting as market conditions change. They also emphasize their long-standing client and broker relationships as a key strength. The competition in this industry is fierce. They face rivals from all over the world, including other big insurance companies and even newer players like insurtech companies. They need to constantly adapt and innovate to stay ahead. This is probably the biggest elephant in the room for any reinsurance company. Catastrophic events from hurricanes to earthquakes to pandemics can cause massive losses in 2025. Their pre-tax net catastrophe losses were $726 million. That is a significant hit, but thankfully down from over $1 billion in 2022 and 2021. They are using sophisticated models to try and predict these losses, but as they say, actual losses may exceed projections by a material amount. The way they estimate future claims or reserves is super complex and very subjective. The report explicitly states that actual losses may differ materially from their estimates if their reserves are not enough. They may have to take a big hit to their earnings and capital. This is where that Warren Buffett style analysis really comes in. It is not just about what they report today, it is about the potential for future surprises, especially with things like social inflation making claims costs rise unexpectedly. Their financial strength ratings are super important for their business. A downgrade could make it harder to attract customers and could force them to pay more to reinsure their own risks. They currently have strong ratings, but the report mentions that some rating agencies have a negative outlook on their ratings. And then there is regulation, lots and lots of it. Insurance is a heavily regulated industry, and changes in laws from the US to Bermuda to Europe can impact their business operations, their capital requirements, and even their ability to pay dividends. Cybersecurity is another huge concern. They are heavily reliant on technology and face constant threats from hackers and data breaches. The report mentions their board has a good grasp of tech risks, and they've appointed a chief information security officer to manage it. All they haven't experienced a material cybersecurity incident yet, but it is clearly a top priority. Business continuity is also a big deal. They are exposed to risks from pandemics, geopolitical events, natural disasters, and at failures that could disrupt their operations. Having backup plans and testing them is crucial for survival in this business. Overall, Everest Group Ltd seems to be navigating a challenging environment. They've made some strategic moves to streamline their business and manage risk. The financial results show improvement in some areas like combined ratio and net investment income, but the increased tax burden and lingering concerns about prior year loss development, especially in casualty lines, are significant risks. Their ability to manage the inherent unpredictability of natural disasters and evolving legal landscapes will be key to their future success. So, what is my take? Everest is a solid player in a fundamentally vital but risky industry. They demonstrated resilience by improving their combined ratio and growing investment income. However, those prior year loss developments and the new Bermuda tax are red flags that investors need to watch closely. The strategic divestitures are a smart move to focus on core strengths, but the true test will be their ability to consistently manage claims costs in a more volatile environment. What do you think about Everest's latest report? Are you impressed with their resilience or concerned about the risks they face? Let us know in the comments below. If you found this breakdown helpful, give this video a thumbs up and subscribe to Corporate Decoder for more decoding of financial filings. Don't forget to join our Discord community linked in the description for even more in-depth discussions. Thanks for watching, and we'll see you in the next one.